In this video, we're going to discuss about what drives every major asset. So most of the times people like to rely on three assets class. So first, Forex, and usually it's 38 currencies, the top most liquid currencies. Then we have the stock market, equities. So most of the time people rely on ETF indices like the S&P 500. And then third, we have the commodities. So typically oil, silver, gold. Gold has been really popular recently for certain reasons because we were in a really big bullish market for multiple years, more than a decade, in fact. So let's dive into it. So first of all, what about commodities? Well, you have to understand that commodities, by all means, as simple as it sounds, are majority driven by supply and demand. So what does it mean? We're going to take the example of gold. It seems like it has a cycle of about 16 years. And usually it's all about having a big bullish market for 10 to 11 years and then a bearish market for about 4 to 5 years. The reason behind that will be due to mine. It seems like from the moment when we really realize that, oh, gold is going up, we should maybe invest in opening new mines to sell gold and profit from that. From the moment they start planning, then there's all these steps, collecting the money, actually planning, actually finding people that you can hire to start mining. And the moment you actually start collecting gold to sell it, it seems like it's a period of usually 10 years. And then what happens is, because gold is just floated all over the market, gold prices suddenly comes back down for multiple years until it isn't so profitable anymore, and a lot of mines just eventually close. And because they close, usually the bullish market just needs a small catalyst to happen again. So during 2000, the big bullish market was mostly caused by all the infrastructure investments in China. Recently, it has been really about all the central banks buying back some golds and AI, obviously. Now, on shorter time frames, usually what we really care about is real yields. And not just real yields, but expectations around real yields. For those who don't know, usually we look at the interest rates of the US dollar minus inflation, and that will be the real yield. So just all alone like that, it doesn't really have that much of an impact. As I said, you have to look at the expectations. Okay, markets always look for what is going to happen and not what has happened. If it has happened already, it's already priced in, so there's no edge in that. So there's a ticker I really like that I'm gonna show you here. If you use it on a chart, you can see that when typically expectations of real yields are increasing, if people think real yields are going to go up in the future, usually gold goes down. And obviously that's the same thing for silver. Now we have equities. Equities are all about growth expectations. Obviously, if people think we're gonna have interest rate hike, this is generally seen as something negative. So this is why most of the times when the central banks start hiking, we can see the US stock market collapse due to that. It's because people are forecasting a recession in the future. Now it has happened that central banks started to hike interest rates and kept on hiking, or sometimes kept their interest rate high after a series of hike, and the market was still going up. All that is because by the end of the day, markets only care about growth expectations. So if people expect the GDP to keep increasing over time, they're going to just keep on buying stocks, and that's going to be seen immediately on the S&P 500. And sometimes on the short term, we can have also some sentiment shift due to some kind of fear of the market that we could potentially hike. And so a lot of people, they most of the time don't really understand when to look at, for example, the NFP data. Sometimes it's good, sometimes it's bad, and the market is just gonna go up eventually, and it's not gonna care about that. And I think that the S&P 500 is driven by the overall health of the economy, but actually it only cares about growth. And so if the NFP comes bad, it can mean that, for example, like it was about 2 weeks ago, when I'm recording this, that the central bank is not going to hike interest rates, and for that, it's great for for growth. But yes, it's bad for the jobs market. But it's not about the job market when we're looking at equities. Now, the third asset class is FX, Forex. So when you look at Forex, everything relies on interest rates. First, we have interest rates, just the difference, okay? When you look at two currency and compare them, the one with higher interest rates, if you sell it against the one with lower interest rates, you're gonna have to pay every day to keep that trade active. So that's a thing you obviously want to take in consideration when you take a trade. So that's why the interest rate differential is really important. And usually people like to buy high interest rates against lower interest rates, and it's called a carry trade. Now there's also the interest rates expectations. Okay, if a central bank is, for example, pretty hawkish, and another one is pretty dovish, meaning they want to cut interest rates, it's gonna also drive the market. Because let's say you have currency A at interest rate of 2.5% and currency B at 3.5%. Currency A, the central bank is gonna hike probably interest rates by about 50 basis points by the end of the year, considering market expectations. And currency B, they think interest rates are gonna go down by about 50 basis points. So by the end of the year, that interest rate differential that was about 1% is gonna be zero. So obviously, if a lot of people took that trade by selling the first currency and buying the other one, what's gonna happen? Well, probably a lot of people of having other currencies are gonna maybe think, oh, currency A is probably going to be interesting because one, they're hawkish, and in 1 year, interest rate will be interesting. It will be attractive. B, the currency B is gonna be less attractive. Maybe a lot of people already bought that currency, and because now interest rates will be reduced, maybe people are gonna sell. They're gonna take profits, and it's not such a good idea to actually take that trade by buying that currency. And maybe we should too sell if we have already gains on the table. So that's about it, about the three major asset classes. I hope this video really helped you. Don't forget to subscribe and like.